Investing. What comes to mind when you hear that word? Probably for a lot of people, it's either something that you're maybe scared of, or you think it's too exclusive and it's something that's not for you. But here's the truth and the secret. Investing is for you. Investing is for everyone. It doesn't matter if you've got £10, £100,000, £1,000, and any number in between. Investing is something that's going to form a key part of your life if you're looking to build towards financial independence and a solid financial future. In this video, I'm going to lay out exactly how you can start investing, especially if it's something you've not even looked at yet or even started. So this video will go through the different stages and things you need to think about before opening your first investing account and take you all the way to that point of opening your first account and depositing your first amount of money. We'll cover what it is, how to get started, and then how you can continue to grow your account over time. So let's dive into it. Hello, and if you're new here, my name is Lewis, and on this channel we talk about everything to do with personal finance and growing your money. And as you'll have gathered from the intro, today's video is going to be about investing. We're going to break down all of the key steps and things that you need to think about in relation to starting investing, growing your investments, or simply just upskilling and learning a bit more about it to help enhance investments you've already got. So hopefully this video will have something for everybody. But we're going to go into the step-by-step guide now of how you can get started with investing. Let's start with the basics. What is investing? It's a word you probably hear a lot. Investing is taking an amount of money that you have, no matter how big or small, and putting it into an asset that grows. Now, the most common form of doing this is to invest it into something like stocks and shares or into an ETF. Those things are really popular forms of investment that allow people to get a foothold in the investing market. There's lots of other things that you could put money into as well. Investing really covers the basics of anything that can grow in value over time. The principles are built on the fact that rather than leaving your money sat in a bank account where it's maybe earning 1, 2, 3% interest, you can use that money, especially if it's not money that you need in the short term, to put it into another type of financial asset that can grow more and at bigger amounts over time. When you invest, your money earns returns. And then if you leave those returns in your investment account, your original money, the money you're depositing, and the returns earn more returns over time. And so begins the compound interest and compound growth effect, which is a key to being able to grow a successful investing portfolio. If you invested just £100 a month at an average return of 8%, which is roughly the average of something like the S&P 500 or FTSE 100 have returned over the last 30 years, if you were to leave that £100 a month investment and just contribute that every single month over the next 30 years, you could have over £140,000 in your investment account. Sounds great, right? That's the power of time and consistency. And they're the two key things that you're going to need when it comes to growing your investments. So why should you invest? If you take a lump sum of money that you have and you were to pop it into a bank account, as mentioned, you're probably likely to be earning 2, 3, maybe if you're lucky, 4% interest on that money sat in a bank account. Now, that money being sat in a bank account does mean that it's entirely safe. However, the returns are very low. The principle of investing is that you can beat those returns and make your money work harder for you. That's why you should invest. I should caveat here by saying that any form of investment is a risk. There is no investment out there that's completely risk-free, and the risk is all your own if you choose to invest and decide to start up an investment account. I am just someone who has experience in this area and has my own investment account, and I'm merely here offering my perspective on this. Nothing you hear today is financial advice. The killer for savings accounts is inflation. If you're growing at that rate previously mentioned, 2, 3%, on average, inflation averages out also at 2 to 3% each year. So that actually means that in terms of the buying power of the money you have in your savings account, it's not going anywhere. If you put £1,000 into a savings account that had 2 or 3% interest on it, in 10 years' time, the number that you see in your bank account will be higher. However, because of inflation, that money will still only be able to buy you the same things as if you were to spend that £1,000 today. That is another reason why investing is a killer. By being able to outgrow inflation, your money is actually improving over time so that you can buy and use more of your money in the future towards more things that you want to have. The next question that springs to mind is, what can you invest in? What is an investment and what things are out there for you to be able to invest in? There are a handful of assets that I would say fall into the main category of investing. We're just going to break down here what every one is. Number one, and arguably the most common one, stocks or shares, however you'd like it to be known. Stocks and shares are you taking your money and buying a small piece of a company that is listed on a global stock exchange. So imagine you take £100 and you want to invest that into Amazon or Apple, some of the most common companies out there to invest in. You would, on any investing platform, you would take your £100 and you would invest that through the app into one of those companies. In exchange, you will get a portion of that company. Now, £100 will only get you a very, very, very small percentage, but still you are a part owner of that company. And as that company grows in value, so does the amount of the company that you own, that also grows in value as well. Number two is kind of a sub branch of what we've just discussed with stocks and shares, and that's ETFs. So ETFs are effectively a basket of companies that are pulled together by a company that specializes in this sector, someone like Vanguard, a company you might have heard of lots before. They will pull together, create an ETF based on a series of companies that meet the categories or characteristics of that ETF. So take a tech ETF, for example. In a tech ETF, you might find that there is Amazon and Nvidia and Google and Meta all inside that ETF. If you invest £100 of your money into that ETF, you buy a small portion of every single one of those companies, depending on how much of the portfolio that company makes up. The advantage of an ETF is that your risk gets diversified. By diversified, we mean it gets spread out because you're buying multiple different companies. If one of those companies were to not perform, as long as the other companies are still performing, then the impact that has on your overall investment is reduced. Instead, if you're buying individual stocks and shares, say you own 5 or 6 or 7 different companies and stocks and shares, if one of those doesn't do so well, the impact on your overall portfolio is much higher. The disadvantage of an ETF is the fact that it might not grow as much as individual stocks and shares. However, there's a massive asterisk attached to that because you have to be able to pick the right stocks and shares for them to outperform an ETF. So stocks and shares, there is potential there for even bigger growth, but you bring in a lot of risk and you carry a lot of risk with you as you're looking to invest. The next category of investment is bonds. Bonds are effectively you lending money to a government or a bank, and they pay you back interest on your investment to them, on you handing over your money. Bonds tend to be a lot safer than stocks and shares because they are kind of have a fixed interest rate associated to them. It does mean though that your money's locked away for much longer. So if you're looking for long-term growth, but you don't want to invest into stocks and shares, then bonds will typically give you a better return than an average savings account. So that's probably a better place for your money. But as I say, the mitigating factor is that you aren't able to access your money for the amount of time that it's locked in for a bond. So if it's a 5-year bond or a 7-year bond, that's it. Your money is locked in there until the end of that bond term, at which point you'll get your money back with the interest that you should have been paid during that term. Bonds are quite a good thing to have as a general part of your investment portfolio. Depending on your age and your risk tolerance can depend how much of your portfolio they can make up. Personally, bonds don't make up any of my portfolio at the moment because I'm still quite young and I'm looking to grow my portfolio as much as possible. So therefore, I don't have any bonds. But as my portfolio grows, it becomes worth more. And as I get older and move more towards my retirement, I will certainly be bringing bonds in because they allow me to move some of that money from the risky assets, stocks, shares, and ETFs, and move them into assets that aren't going to cause such volatile fluctuations in my portfolio. So yeah, bonds are a really good thing to think about having as part of your portfolio. And depending on how you feel about risk and certainly the age you are at the moment, will determine how big a part bonds play in your portfolio. And then the last main category, which we're not going to cover too much in this video, but just something to be aware of, is that you also have the opportunity to be able to invest in individual property or in something called a REIT. So a REIT is effectively works the same as like an ETF does, and it works in a way that you pull together lots of different properties, particularly commercial property, and you buy a small piece of all of the value of those properties put together. So if you imagine somebody decided to start a REIT and they went out and bought a few factories, a few high street shops, and maybe some commercial office buildings, they would pull the value of all of those together, and that would make the value of the fund. Just like with an ETF, the value of an ETF is all the companies pulled together as one. And you would then put your money and buy a share of that REIT by passing over your money and getting something in exchange, a share of some sort. Then when that property is sold over time or rented out over time, the money that you have earned and the growth on those property is then paid back to you, so you get an enhanced share compared to what you invested. Okay, so that's covered the different type of investments there are, and there are others out there, but they're kind of the main ones that you're likely to come across on your journey. But now let's get started into actually investing. So there's a few steps we need to go through to get you off the ground and investing. The first thing we need to do is check your financial foundation. So your financial foundation and your ability to start investing should depend on a few things. Firstly, do you have any high interest debt that you're carrying? If the answer to that question is yes, that's what you should focus your money on. Get that debt paid down and get rid of that first before you think about investing, because otherwise you're going to be earning money, the money you're paying into investing, but then you're going to be paying interest on your debt, and those things will balance each other out. You're also going to want to get together a small emergency fund as well. I've actually done a video separately on emergency funds, so please do go and check that out, and I'll link it down in the comments. But building a small emergency fund of something around £1,000 just to allow you to cover any very short-term unexpected costs is also really important before starting investing. And then lastly, you need to work out how much can you actually invest. So if you've got an emergency fund built and you're not adding to that and you've paid off all of your debt, great news. This is a really good platform to start investing. Now, using your budget tracker or however you work out how much money you spend each month, take a look at how much money you can invest and also tie that into a future retirement plan. If you go and check out some of my budgeting videos, I'll show you how I've created one of those and how you might be able to do the same. And that will give you a good indication of how much money you should be investing. Next step is choosing the right account for you to get started. So there's really two main ways that you're likely to invest in the UK in terms of opening up an account and getting started. The first one is through a stocks and shares ISA. A stocks and shares ISA is pretty much what it says on the tin. It's an ISA product. So if you're in the UK, you'll know that means you can put in £20,000 and that money goes into the ISA, and then any money that you earn back comes back to you completely tax-free. Great account. If you haven't got one of those already, I recommend getting one set up as soon as possible. Good accounts that offer them, have a look at Trading 212 or Moneybox or Nutmeg. They're all accounts that I've actually used in the past and have set up ISAs through. So yeah, go and check out any one of those. None of those are affiliated to this video. They're just products that I've used in the past. So yeah, please do go and check them out because they're a really good starting base, and most of them have really low fees as well, which is another great way to get started. The second most common way, or second common way, is likely to be through your pension. Now, you might actually have already started investing and don't even know about it, because your workplace pension, i.e. money that comes out of your payslip every month to go into an account that has been created for your future self, for money for you when you are retired, that account already exists. If you're working in a regular workplace 9-to-5 job at the moment, you will have a workplace pension. By law, your company has to enroll you into one. So if you go and find out the details about that, you'll probably find that you've already got some money invested at the moment, and it's already being invested into stocks and shares. That is the most likely route for workplace pension. So definitely go and, if you don't know about your workplace pension, go and speak to your employer, because you'll be able to find out lots straight away. But that's the second common way to invest into stocks and shares, is through a pension, whether that be setting up one of your own if you're self-employed or through your workplace one. And you can contribute more money to your pension as well. So you can decide how much money goes in. All you need to do is let your employer know what percentage of your salary you'd like to contribute. And the advantage of doing it through auto-enrollment, which a lot of companies are, is that the money goes out before you get taxed on your salary, which actually means that you're getting a nice little tax rebate before your money that then reaches you in your salary each month comes through. That pension amount is removed, then you're taxed on what's left. So yeah, a nice little tax buffer as well. So definitely take advantage of your workplace pension. The next step, choosing your investments. I'm not going to go into too much detail here because I've kind of picked on it throughout the video and summarized it in different ways. But effectively, do some research and work out what's best for you. Go through all of those previous options I listed for different types of investments and pick the option that works best for you. Just because stocks and shares or ETF work for me might mean that bonds or property or REITs work for you. It depends on what you feel most comfortable with, any expertise that you might have in a certain area. So just go away and do some research and see what works best for you. And then particularly if you're doing stocks and shares, ETFs or bonds, using one of those platforms that I mentioned earlier, you'll be able to get an investment account started in literally a few quick steps. And then lastly, automate it. What you don't want to have to do is think about this every single month when it comes down to it. Pick an amount that you're comfortable to invest in, set up a direct debit from your personal account to your new account, your new stocks and shares ISA, whatever account you've set up a direct debit so that at the start of every month, that money goes out and straight into your investment account. Voila, you don't have to worry about it. It's being done automatically for you. So good news, you've got your account up and running. You've set an automated direct debit to going in. Now we're just going to cover really quickly a few bits to avoid doing now you've got your investment account up and running. The first thing is trying to time the market. I promise you it won't work for you. No matter how much time you put into it, market timing is always something that is nigh on impossible to do. There are so many experts out there in this field that still can't time the market. So you yourself, you don't want to be timing the market. You just want to be investing consistently every month. You'll hear a phrase that quite often gets bandied around called dollar cost averaging. And dollar cost averaging, or pound cost averaging if you're from the UK, effectively the same thing, is investing consistently every single month without worrying about the ups and downs of the market. So if the market is really high, you're buying. If the market is really low, you're buying. By doing that, you'll average out your returns across the duration of the time that you're investing to get a nice stable growth throughout your portfolio. Secondly, don't invest anything you need soon. If you need money in your emergency fund or you've got expenses coming up that you know about, don't invest them in the hope that you'll be able to take that money back out in a few weeks or a few months' time and you'll have more money. It doesn't work like that. You need to leave this money that you're investing in your account for a long period of time. So don't use the money you're investing for anything you're going to need it for in the short term. The third thing is please don't follow hype. You'll see anybody from down the street recommending a stock on TikTok that they've just invested a few £100 into and it's gone to the moon. Sure, great, that might be true and that might have worked for them, but by the time you're seeing that, the growth is probably already gone. So just steer away from anything like that. Steer away from any advice that's coming from people that you don't trust in particular. Make sure if you are going to take stock and shares advice from somebody, make sure they're a qualified professional and they know what it is that they're instructing you about and why you should invest that money. But my advice would be don't follow any hype around stocks. Just keep investing consistently into things like ETFs or your own stocks and shares portfolio that you've created and you're sticking to over time. And the last main one for this video is don't panic sell. Markets go up and down. Now this applies less, I guess, if you're in bonds, but this particularly applies if you're in stocks and shares, you're in ETFs, or you've gone down the route of REITs as well. But particularly the first two, stocks and shares and ETFs. Please don't make the mistake of panic selling. Please don't think that because the market's down, I've got to sell all my stuff now and I don't want to be involved in this market anymore. That's the worst thing to do. All you do there is bank a loss. You're not gaining any money. The likelihood is it might have dipped below where you started from. You don't want that. As long as you stick at it, you invest consistently, I promise over time your investments will grow. If you go back through the entire history of the stock market, there are several crashes in there, and you go back to all the crashes in history, there's lots of them in there. But every time the market rebounds and ends up in a place further forward than where it was before it crashed. So again, my advice is automate the investments, let it go in every month, and then try to not look at it too often. Regardless of anything you hear in the news about stocks and shares going up, going down, don't worry about it. You just keep doing what you're doing and keep doing it consistently. So we're up and running with our investments. We're avoiding the key pitfalls. The next thing to do is look at what a sensible portfolio might look like. Now, I've mentioned before in this video that really it can vary depending on your age and your time horizon. By your time horizon, I mean when you're looking to cash out this investment. So depending on those things can depend and influence what an ideal portfolio looks like for you. But let's take, we'll take myself now, I'm in my early 30s, and then we'll perhaps take somebody in their early 40s, just as those two kind of age brackets. You can take anybody younger than me, anyone younger than me watching this video, you're wanting a similar position to me, and I'll explain why in a minute. If you're older and watching this video, you're older than 40s, you're in your 50s, your 60s, you may want to consider adjusting these numbers. So from my personal perspective and my accounts, All of my money at the moment is invested into ETFs. I don't hold any money in bonds. I don't hold any money in ETFs. The reason being is I've gone for what I think is a safe but growth-based objective to get through for me for at least the next 10 years of my life. So I'm looking to try and grow my money as much as I can now so that I can begin to diversify further when I get into my 40s and 50s. So my allocations, it's 100% in ETFs. Now, if you're in your late 30s or going into your 40s, what you actually might consider is something along the lines of 80%, 70% of your money in stocks and shares, but 20 or 30% of your money actually in bonds. And that means that whether it's you've had the account for a while and you've decided to go down that route, or even if you're setting up the account as brand new off the back of this video, which would be great, you're just diversifying your money a little bit. You're just giving yourself an anchor, and that consistent growth that will come from your bonds in the 20 and 30% carries a lot less risk. It's not going to give you as big a return, but it does carry a lot less risk and just gives your portfolio, I think of it as an anchor. If you imagine you're on a ship and you're sailing along, the amount of money you put into bonds just gives you a base to be able to stop and settle in one place. So yeah, just something to think about. As I said, if you're in your 20s, you're younger than me, you're in your 20s, going all out for growth right now is a really good strategy, in my personal opinion. I think it's a really good way of getting your money moving early on, trying to take advantage of as many returns as possible, so that then when you get to those 40s and 50s, you can look to diversify that portfolio. So there you have it. There's my guide on how to get started with investing. And there's lots of steps in there. And please do make sure you save this video, give it a like, subscribe to the channel if you like the content, because there's going to be lots more content like this that hopefully help you get started with investing. And just think through the steps we've been through today. You know, work out your financial position. Are you paying off debt? Do you have a good enough emergency fund to get started? Do some research on accounts. Check which ones work for you, which platform you like the look of, which one you think is going to be easiest for you to use. Have a read through, rewatch this video, listen to kind of the guidance on what the different individual assets are that you can invest in so you can choose the right one for you. Open your account, automate the input into it, and let it go. Don't keep looking at it. Don't keep checking in on it. You just set that account and let it grow into the future. The market's going to go up, it's going to go down. But the key here to this idea is to making sure you're just investing consistently and not taking your money out in the lows or trying to time the market in any way. And then there's a few things in there as well that you want to avoid, and just make sure that you don't fall foul of any of the pitfalls of investing that might mean that you double down on your losses rather than keep growing your money. But yeah, hopefully you found this video interesting. I'm going to do lots more on kind of guides to investing, guides to saving, guides to emergency funds. So yeah, hopefully you found this content really interesting. If you've got anything, any feedback, anything you want to say, please do drop it in the comments. As I say, subscribe to the channel because there's going to be lots more content like this coming up as well. But yeah, other than that, as I say, I hope you enjoyed it, and I will hopefully see you back here soon in the next one.